take your seats. We'll shortly begin thematic session 3. I request all of you to please take your seats. Requesting everyone to please settle down. Request everyone to please settle down. We'll begin thematic session 3 shortly. Before we begin with the session 3, there's an announcement about the dinner tonight.
Yeah, I have actually two important announcements. One is regarding this pass that has been issued to the participants. This time onwards, we are trying to do our bit for recycling. So at the end of the proceedings tomorrow, we'll request all the delegates and the participants to kindly drop these passes at the registration desk so that we can use them again next time. That was the first announcement. And second and more important, National Disaster Management Authority is hosting a reception dinner tonight. All the participants are cordially invited. The venue is in this hotel in the terrace garden. To reach the terrace garden, you have to press level P. P for Papa. And the time is 7:30 p.m. All the participants are invited. In case you find that the colleagues that you know are not presently present in the hall, kindly spread the word around. Again, in the interest of saving paper, we are not issuing any formal invites. Thank you very much.
Thematic Session 3 on Finance for Disaster Resilient Infrastructure will be moderated by Dr. Krishna Vatsa from UNDP. This session will have 3 speakers: Aniket Shah from Oppenheimer Funds, Rowan Douglas from Insurance Development Forum, and Professor Ila Patnaik, National Institute of Public Finance and Policy, India. Shah, from the New Development Bank, will also join us on the dais. I request the moderator and the speakers to please take their seats on the dais. Thank you, everyone. I'll now request Shri Kamal Kishore, member NDMA India, to introduce the session.
We are a little bit behind schedule, so I will go really quick on this. I think this was one of the most difficult sessions to put together because of the sheer scope of the topics that could be discussed. Some of the speakers, when we were discussing it and putting together, they were saying that how are you going to discuss this vast topic in 90 minutes because so many things are context specific. But there is one thread that we picked from last year's workshop, which was that last year's workshop was overly heavy towards insurance, and we wanted to bring about a more rounded perspective here. So Aniket here will talk a little bit from a private financier's perspective on infrastructure issues. He's been very involved with the whole SDG discussion, infrastructure financing gap, and so on. And Rowan, who is no stranger to anyone by now, he will talk from the perspective of Insurance Development Forum. And Dr. Ila Patnaik, she will present the challenges that we have in an emerging economy like India with regards to finance. With that, I hand it over to Dr. Krishna Vatsa to moderate this session.
So thank you very much. I'm so grateful to the NDMA for giving me this opportunity to chair this session. I'm Krishna Vatsa. I'm recovery advisor with UNDP. The session that we are chairing is on financing for the disaster resilient infrastructure. Certainly the most important session of the workshop, Absolutely, that's, I just acknowledge that, it goes to the heart of the issue. How do we bring in finances which promote resilient infrastructure? I would like to say right in the beginning that this is not exactly about financing for infrastructure, this session. That's a huge topic. It's basically for promoting resilience through finance, in infrastructure building, infrastructure maintenance. So how do we use different financial mechanisms, instruments, innovations to promote risk reduction and resilience in infrastructure building? That's what the session intends to focus on. So basically, we are looking at three important aspects of the financing for the resilience. One, what kind of incentives are we going to build for the government and financial institutions for the private sector? The second, what kind of financial mechanisms and instruments that are available for risk transfer in infrastructure sector? And third, how do we allocate resources for rebuilding our infrastructure in the post-disaster recovery context? So it's about building resilience, kind of ex-ante solution, then risk transfer and insurance solutions, and then post-disaster resources for post-disaster recovery and reconstruction. Some of the critical questions that would be raised and discussed during this session are as follows. How do we present a case for allocating resources for building resilience? And how we can go beyond the traditional tools such as this cost-benefit analysis to more dynamic risk assessment models which justify these investments in resilience. How can the private sector and the financial institutions which are funding infrastructure be more informed of risk and resilience considerations? And how do they factor them in their decisions related to infrastructure investments? Third, what are the different financial instruments such as insurance products, insurance services, and bonds, risk pools, which could be innovated for improving resilience of infrastructure? Fourth, how can we set up a multi-layered risk management arrangement through which infrastructure projects could retain an acceptable or optimal level of risk before transferring the risk to the markets through insurance? Fifth, how do we develop large-scale risk pools, particularly in the context of emerging economies, through which risks to infrastructure could be addressed and adequate payouts be made available for recovery and reconstruction? And finally, how do we have a proper ownership of risks? How could various stakeholders such as the government, private sector, insurance companies, and international financial institutions participate in a risk management arrangement in an equitable manner? So it's about discussing some of these issues. We have three great speakers here. They are bringing different perspectives. They have been introduced, Aniket, Rowan, and Ila Patnaik, very eminent in their fields. And once they have about 15 minutes to present on this issue, and then it would be followed by, I think, 6 discussants, and I would request them to be, very brief, so that we have more time for question and answers. So with this, I would like to invite Aniket to inaugurate the session. He's a firebrand speaker, and you will see him in action very soon.
Thank you very much. Let me start by thanking the NDMA and the United Nations and all the partners here for the invitation. You can take this off, whoever's in charge. If you're so excited, I can give you the reading notes at the end, but it's really a privilege to be here and a pleasure to be able to share some thoughts and reflections about how we finance infrastructure, how we finance resilient infrastructure, and how we make sure that this next 15 years of enormous investment, both public and private, is done in a way that's resilient to the changes that the world will go through. So my remarks today will focus on the following 4 areas. First, I want to start by taking a step back and reminding us of 2 of the major paradoxes that exist when it comes to financing infrastructure and specifically financing climate resilient infrastructure. These 2 paradoxes are ones that I've lived through in my professional life, currently as the head of sustainable investing at a firm that deploys $250 billion of private capital around the world, and previously as an advisor to governments around the world on the SDGs. Secondly, I want to outline some of the specific challenges when it comes to financing both public and private climate resilient infrastructure. These are all issues that you all deal with on a day-to-day basis, so I won't focus too much on the problem side. I think you know many of them, but it's worth just highlighting at least what's on my mind. Third, I want to give a few reflections on where I see the successes and the challenges since 2015. As you all know, over the last 3 years, there's been a tremendous amount of international policy work with the Sendai Framework, the Addis Ababa Action Agenda, the SDGs, the Paris Climate Agreement, and so forth. And I think we have some reasons to be optimistic, and then some cold, hard facts that make at least me quite cynical and pessimistic. And fourth, I want to end with some concrete ideas of where we go next and where this coalition can focus their efforts on next. So that's what I'm going to try to do, and I'll be quick because I know I probably only have 13 minutes left. Before I begin, let me just start with 2 high-level comments. First is that infrastructure finance and climate finance specifically is extremely context-specific. I was telling Kamal and the team, I actually feel a little uncomfortable talking about this in broad sweeps because in reality, there are very few general statements or principles that actually are relevant to all of you. So I just want all of you to know that I go into this session with a keen awareness that each country, each city, each project actually has different sources of public and private capital. You're operating in different regulatory regimes and so forth. And there isn't a best practice that is available for all countries. The second overarching comment, at least the way I see it, is that there are 2 distinct questions here, although related, when it comes to how to finance climate resilient infrastructure or resilient infrastructure. The first is how do you solve the infrastructure problem in and of itself? And I'm not willing to give up on that topic even in today's session because that is an unanswered question. And each year that we have multi-trillion-dollar investment gaps, the challenges get harder and harder going forward. And then the second challenge is, of course, how do you make sure that this investment is done in a way that all of these significant climate risks are taken into account? So again, there are 2 distinct, although related issues that I think we all need to wrap our minds around. Okay, so the paradoxes. You know these paradoxes, but it's one that I live through every day, and I think you do perhaps too. The first paradox of climate finance, of infrastructure finance, of resilience finance, is this coexistence of enormous supply and demand of capital, and our inability to link the two. And when we talk about infrastructure finance, you have to think about it both in public investment and private investment. On the public investment side, many of you in this room might say, oh, that's easy to say that there's $300 trillion of wealth in this world and it's not being taxed appropriately and so forth. But I will not give up on this notion that there is more than enough public resources at a global level for us to finance infrastructure and for us to finance climate resilient infrastructure. On the private side, this is even more the case. I live through this every day. Institutional investors and banks looking for projects to invest in, but being unable to do so. That's almost a daily occurrence for me. The second paradox in all of this, and something that I think Rowan got to earlier today, was that a lot of the issues when it comes to adaptation and the insurance sector in particular, we know how to do this. And we've known how to do this for a long, long time. Insurance is not a new space. In fact, it's been around for hundreds and hundreds of years. And the institutions that are needed to promote broad-based insurance and resilience have also been around for a long, long time. So I remain just flummoxed by the notion that we have the capital, we have the needs, and we have the instruments, but we aren't able to link this all together. Okay, so what really is the challenge when it comes to climate and resilient infrastructure? I see sort of three parts of this puzzle. First is that we just have a shortage of capital in general that's going into this space. And by the way, this is mostly a shortage on the public investment side. Every year that we underinvest in infrastructure, the challenges become more and more difficult the next year. I don't want to go into the details of the infrastructure gap because there are many, many estimates out there, but I think the World Bank did a very good analysis recently with this Beyond the Gap study where they reminded us that yes, there are significant infrastructure gaps from a funding perspective, but a lot of this depends on the choices that we all make today and what are the outcomes that we're looking for. The one point I will make about the infrastructure gap, though, and this, the New Climate Economy report in 2014 and then followed up in 2018 really hits home, is that the difference between solving the infrastructure financing problem on a high carbon or a non-resilient pathway and doing so in a resilient pathway is nominal. So it's not a significant amount of additional cost that's needed. It is a additional cost that's needed up front, but certainly pays for itself over time. That, of course, then goes into the whole short-termism of both public and private investors, huge topic which we can get to later. The second challenge is the shortage of specific types of capital. And here I'll put on my private investment hat. I find it remarkable that despite 50 years of the World Bank telling us that there's not enough quote-unquote bankable projects and investable projects, we actually haven't figured out financial systems that allow for more equity investment into the early stage project preparation of projects. And there I sit as a private investor thinking that there would be enormous benefits if we can have more projects in the pipeline that appeal to different risk-reward tolerances of investors. But there are very few governments that have actually gone ahead and built that pipeline with private investors in mind. And I think the IFC is doing a good job with their InfraVentures project, but it's just too small, frankly, $150 million. We need tens and tens of billions of dollars of early stage project preparation money, and that money is nowhere to be found. And then the third big challenge, as I see it, is an institutional problem. We were reminded today at the opening session, which I thought was really a phenomenal set of participants, of the institutional issues when it comes to infrastructure financing. And by the way, these are institutional issues, both as rules of the game as well as specific organizations. By rules of the game, I mean, do we have the right PPP frameworks? Are they standardized? Are they applying to private investors domestically and internationally? All of that's very important. But then do we have the right organizations? And do those organizations, are the development banks and the infrastructure banks, and then in the private banks, do they have the right skill set and analyses to do the type of things that are needed for infrastructure financing? I think that is a unanswered question and a big challenge. So what have we done since 2015? I think you all, and certainly I've been to dozens of conferences like this. Many of the similar topics have been brought up. What have we excelled on and what have we not? So I think there are three major areas of progress when it comes to financing climate resilient infrastructure. First is awareness. I think it's remarkable that the financial community is talking about climate change and using it as a portion of their risk analysis when they allocate capital in a way today that I wouldn't have even predicted 5 years ago. We heard earlier today about the TCFD, the Task Force on Climate-Related Financial Disclosures. You've seen a significant uptake in that norm. You have the Principles for Responsible Investing, which has over $25 trillion that's aligned to it. You have the Principles for Responsible Insurance and Banking. So there is an awareness around this, which I think is in large part due to the international policy frameworks that are in place. The second big progress, I would say, is experimentation. There are more types of investment vehicles out there trying to solve different parts of the investment gap than ever before. Here in India, I've been watching from afar the creation of the NIIF, which I think is an interesting institution. At the IFC, you have things like InfraVentures, which I mentioned, which is trying to solve a very specific problem, but an important problem, and on and on and on. There are more people trying different things, which I think is a very good thing. Of course, we have the AIIB and the New Development Bank that have been created. Both of these institutions at least say that they're going to take climate change into account from the get-go, and I think that's very good. And the third positive is the data. I think this has been a cross-current of everyone who has spoken so far. The data for us to do risk modeling, whether it's public equities, private equity, infrastructure investments, is getting much, much better. I think one of the things we have to now ensure is that that data is in the hands of as many people as possible. One of the problems with a lot of these data sets right now is that they are private and they're not accessible to many government agencies around the world. So that's the positives. The pessimism that I have is that we actually haven't seen on the ground progress anywhere close to what's needed for the SDGs to be achieved or the Sendai framework to be implemented or the Addis Ababa Action Agenda to be achieved. I won't go into the numbers in too much detail, but I'll just say one that to me was really quite extraordinary, that in 2018, the African continent had less infrastructure investment than in 2017, and in 2017 had less than 2016. So the continent where I do a lot of my work that probably is in most dire need of all types of infrastructure has actually seen major declines. The United States, the country where I'm from, has the lowest government investment as a percentage of GDP in its 70-year history, and on and on and on. So where do we go from here? Well, my simple sort of ask, I think, for this coalition and for all of us is to figure out what do we scale up and how do we accelerate what we are currently doing. I'm not sure if we have time, frankly, to do a lot more just ground level ideation. I think we have to take what we know works and accelerate it 5x, 10x, 50x. And for things that aren't working in each of your respective geographies, we have to shut them down. And there's a whole bunch of institutional problems and questions that brings up, because although it's important that we mainstream climate risk into everything that we do, and it's important that we mainstream the improved data in the way financial allocators allocate capital and so forth, we have to ask the question, what's going to allow that to happen very, very quickly? And I think that is, in my mind at least, that if a new body is to be useful in this whole space, it's about scaling up, accelerating, and then shutting down things that aren't necessarily working. So I'll leave it, I'll stop there. My good friend, Rowan, I think is going to focus on the insurance and the climate resilience part of this, so I'll hand it over to him now. Thank you.
Rowan.
Thank you very much, Aniket. Aniket always provides a tough act to follow. Oh, that's good. Slides arrived before I did. Wonderful. They're with me here. Are they with you on the screens? Not quite yet, but yes, I'm going to pick up to some degree where Aniket left off, and I'm going to explore some of the insurance and risk-related themes. As some of you know, I work for a big insurance and reinsurance organisation called Willis Towers Watson, but actually I'm here with a different hat on to represent a group called the IDF. And I'm actually going to just spend a couple of minutes explaining that group and how actually its motivation aligns very closely with, I think, the coalition that you're building, and then practically to explore how we can go from the ideation to actually potentially something practical over the next few months and into the next few years. Both how can I put it, practical nitty-gritty conversation, but actually ideally practical implementation, albeit at a sort of pilot stage. There we go, things are working. Now, I think I'm just going to send a couple of slides I'm going to go through quickly because they've already been shown. This looks just like Jim Hall's slide from earlier. There you go, Jim. Hello there. And one of the things that's going to be interesting is I'm a risk monger from the world of finance in the City of London. I'm about to share some slides which are almost exactly the same that Jim showed or Andrew Maskey will have shown. And that's quite exciting. For the first time, our worlds are not just marching to the same beat, in this case, a set of global agreements, which suddenly we all seem to be sort of coming to the candle like the moths. Wherever we come from, we're all beginning to sort of march to the same beat, and we're all about to begin to start use the same language and the same financial and analytical metrics. This sounds a bit nitty-gritty and trivial, but it's absolutely fundamental. So the insurance industry is beginning to march to the same beat that you are, the same marching orders, both our risk management side and our investment side. And the reason is because actually we've got too much capital in our industry for a variety of reasons. We need to grow demand. Demand for insurance and investment often is always driven by public policy and regulation. Ergo, ensure that your sector lines up with this and is helping governments answer some of their big grand challenges. If you can do that, you're probably future-proofing your industry. My industry is the insurance industry, which is why we're trying to line up there. Very quickly, the industry began to tune into Sendai and to the SDGs and came together to say, none of us can individually do enough, but collectively perhaps we can. And also, a lot of the work that needs to be done, for example, in new ways of ensuring infrastructure, investing in it, is pre-commercial. It's pre-business development. It's actually almost market development. And collectively, none of us have enough resources to do that. But actually, if we combine our resources, but also our sort of leadership weight, we could actually engage in the pre-competitive development stuff, which up till now, no one can do. And that's exactly the space where I think we may be operating together in the coalition. So a couple of photographs. Now, this may not mean much to you, but to our industry, it means a great deal. There's a table with people around it, and it had, this is the IDF steering group, Helen Clark, who was at that time head of the UNDP, your ex-boss. It had Mark Carney, head of the Financial Stability Board of the G20, It had a number of, well, senior leaders of the insurance sector, some of whom were arch competitors and had barely ever met each other before, but they'd all come together to actually address this challenge, and the one I'll explain in a minute. Or, unusually for us, the chair of the then chair of the IDF on a panel with President Kim and Ban Ki-moon, and I think it was Ségolène Royal. Now, some of you will be aware of the sort of the diplomatic hurdles required to get to that point. And actually, the big challenges were in the industry for people to actually say, no, this is real, this is important. And bringing us up full speed, the G20 meeting in Argentina, which was mentioned earlier on, big focus there on infrastructure investment. Actually, the first time the insurance sector had ever been asked to go to the G20. This was the first ever G20 insurance summit in a beautiful area called Bariloche. But actually mobilizing risk sharing and investment for developing an emerging economy infrastructure was the primary theme, obviously, to line up to the goals. So, of all the areas that the industry could decide what to focus on, in this group co-chaired by the UN, World Bank and the industry, there are 5 areas of focus. The first is on sovereign and sub-sovereign insurance programs. That's basically how can we arrange programs to protect governments or cities or regions to insure their risk against climate. And infrastructure is obviously a key concern of those agencies, as well as obviously their populations. So we were here 4 months ago talking about the people, now we're talking about the infrastructure. And this is about making industry expertise available to then prepare the ground for the sort of interventions that we made. Risk modeling and mapping, we've heard a lot about that. Microinsurance, maybe not quite so important for today's discussions. Insurance regulation and resilience policies, absolutely essential to enable the capital to flow in the right direction. We have to have the right policies of resilience in a country. What is going to be undertaken at a federal level or at a local level? To what extent public and private can work together, as well as the specific insurance regulations. And finally, a key part of the industry's role, we feel, is mobilizing some of its $32 trillion of assets under management, often long-term assets under management, so a little portion of the world that Aniket was talking about. Who better than insurers to think about long-term infrastructure risk? So that is the frame of this IDF's scope. And you can see how, for us, the coalition that's been brought together here in India, but it's obviously an international coalition, is an incredibly exciting vehicle to engage with, because the missing ingredient for us are actually the demand-side partners who want to explore, experiment, and actually try and do things. This was a meeting of ASEAN, actually, a little bit further east. ASEAN finance ministers this time last year on exactly the subject of how to make their economies resilient to climate and natural disaster risks, and we were lucky to be engaging with them. So that's, if you like, the big picture. Things are aligned. The goals in front of us. We just need to score some. So here is a graphic that Jim could have probably put up on the screen. It comes to my point earlier. Lots of people in the climate space will be saying we need to make infrastructure resilient. And they may begin to start looking at maps. These are people who are used to counting carbon and talking about sustainability. The real truth is that if you want to talk about resilient infrastructure, it's the expertise in this room, the disaster risk reduction community, who are used to going from hazard to risk through the channels of exposure, which are the key. It's your expertise which is absolutely fundamental. So you have to educate your wider community in the resilient development space. Meanwhile, in my world, the insurers are very used to this world. This is our business. But our challenge is, a little bit like you, we're relatively small and sometimes a bit removed from the bigger ocean. And our challenge is to communicate this world to the wider banking and investment and financial regulation community. So we both have a shared challenge of sort of reverse taking over that wider world. And so I thought I'd go again to Andrew Maskery. Andrew Maskery's work with GAR, this was a stress test basically of looking at the fiscal state of countries around the world and whether they could withstand a 1 in 100 natural disaster year. Currently, not looking into the future, you'll see that larger countries like India tend to be at a national level relatively resilient. Probably be a slightly different picture if we went down at a provincial or local level here in India. So geospatial scale is important. But the thing I wanted to really highlight is this is exactly the same sort of map that insurers would which insurers would use. And so we actually talk the same language. We have to do our own work together now and then export that. So here's an example. This is an example of some work that my own firm did, but I don't want to promote Iwdri. It's just a slide I had to hand. But again, it could have been someone else's. But this is probably a slide that Kamal would recognize, because this is a flood model for 25 key urban centers in India, fluvial and pluvial, so that we can assess flood-related risk for properties and other assets in India. We are absolutely talking the same language, and we found ways of taking this sort of information and integrating it into financial decision-making, into credit risk, and to other things. Can we work together to make some of these tools available and also probably share data in both the same way, but use some of this experience to inform what is the economically rational level of added resilience necessary in an infrastructure asset, and how can that slight, and it's probably relatively modest, increase in capital expenditure at the front end to make something resilient enough, be shown a benefit in the reduced operating costs going forward, or the reduced risk of perhaps a break in earnings, whether it's tolls on the road or whatever it might be. This is a sort of innovation we need to make, but the key point I want to share is we are all talking the same language. It's a beautiful thing. So a bit further down the track, this is how we have to look at understanding infrastructure risk. I dare say for you engineers in the room, it's a very similar set of 6 boxes. How exciting if we could work together to say, how can the best type of infrastructure planning be optimally represented in the financial sector so that it gets the best financing possible, particularly under the new regulatory realms that we've heard about, where climate risk and other natural disasters will increasingly be accounted for. So I'm rushing through this. This is, again, some further examples, one from a credit rating agency, one from a banking regulator, the Bank of International Settlements, and the OECD. Don't worry about it all if you can't read it, but basically it's saying climate and natural disasters is going to be taken much more into account quantitatively in risk, in financing and credit decisions. We've seen this before. Again, we're all using the same slides, which is quite exciting. I was asked to talk about sort of risk pooling and risk transfer, and I will a little bit, and then I'll perhaps sort of outline a possibility. So the first thing to say is there are basically 2 types of, once you've figured out what your risk is and how to reduce it, but then how much you can't cope with and you need to transfer it, there are basically 2 types of insurance. There's the traditional insurance. You buy a policy, the event occurs, you get people coming in, seeing how much damage there's been, takes quite a long time, and eventually you hope that they write a check. That's the sort of insurance that we have for our homes. That's called indemnity insurance. It's been around for about 300 years. With the advent of new data and analytics, actually there's a new kid on the block, relatively new, about 25 years old, called parametric insurance. And it's a bit simpler in some respects, has some challenges, but fundamentally it says let's think, if a Category 4 typhoon comes too close within, I don't know, 10 miles of your city as Category 4, you can be pretty sure you'll have X amount of damage. And let's say you have a 1% chance every year of a Category 4. The bottom line is, and let's say you figure out it does you $100 million worth of damage. Broadly speaking, a little bit more than $1 million a year of premium will buy you $100 million of coverage. And if that hurricane comes too close and the satellites say that it's within the grid, that money is sort of transferred immediately. It's called parametric insurance. What's exciting about it is it's quite easy to understand, and it's quite flexible, and it allows all sorts of people to participate in the insurance marketplace. So the first thing I'm going to say is lots of things can be insured, and you don't need to create complicated risk pools. The insurance sector is pretty large globally, doesn't have enough demand in emerging and developing markets. If you come to the market with actually very large risks, you don't have to worry about the pooling yourself. The industry globally will sort of do that for you. So the first thing I want to say is that sometimes people get into the sort of challenging end of insurance when actually it isn't necessary. But nevertheless, and this will be a governance issue, there may well be, Kamal, for example, you tested me a few months ago and said, how many new airports are being planned in India? And I thought it must be a big number and said 40, and you sort of politely smiled, and it's sort of over 200. There could absolutely be an approach where, depending on, I'm sure the ownership of those airports is varied and it's all quite complicated, but nevertheless, you could imagine a situation where there was an analytical approach that tried to ensure the airports were resilient to a required level, and airports that met a certain level of resilience could share their risk together in a pool to ensure their operational as well as broader resilience. But then for an extreme event, which would knock a number of airports out, that pool could be reinsured internationally. That's the sort of arrangement that could happen, I think, relatively easily. So that's sort of aspects of risk transfer. A lot of this in India, but around the world, will be how to balance public and private investment and risk. And I think that's an exciting journey to make. How much of this risk is appropriate to be shared in the private sector? How much does the public sector want to retain? Because so much of the infrastructure investment, I'm sure, that will be happening will be in the public domain. The final point I want to make before an invitation is the idea of blended finance. So for me, it's really lovely. Blended finance is one of these words that sort of means everything and nothing, but I never used to get invited to blended finance parties because I'm an insurance person and it was other people. But now, I've been invited to blended finance parties because insurance is now part of the blend, part of the cocktail. It's the new kid on the block. But what's exciting is this new sort of parametric insurance is suddenly sort of making our world a bit more accessible. So I'll give you an example. Kamal, if you had an airport somewhere in India that wanted to build its new terminal or its new runway, and it needed to raise, I'm going to make up a number, $100 million to build that runway or that terminal, and it would potentially issue a bond, either as the airport itself or maybe the local province, and it would issue a bond. All good, normal. But wouldn't it be exciting if we could sort of wrap that normal bond, that normal municipal bond, and turn it into a municipal resilience bond, so that if that nasty climate event happened, that bond would be automatically forgiven or ameliorated or in some way deferred, so that actually that airport, now that's very exciting. That's a sort of blend. And the key thing is to do as little new as possible, but to make things simple. So my invitation before I sit down is to say, somehow, and it was by grace of something, the industry has got together on the SDGs. They focused on climate resilience. We have 200 people lined up working on some of this. We have a secretariat that's just been established. The key need, and I'm the OPCO chairman, is to find tractable partnerships which have a prospect of leading to more than just a report. What could be more exciting if during tomorrow's sessions with the different sectors that you've put together, if there is any group that says in any country, we want to explore some of this practically, in principle, I'm absolutely sure that a team could be put together to participate in that journey with you as part of the consortium, the coalition that's being put together. So the timing could not be better. But thank you so much, Camille, for letting me speak this afternoon.
Thanks. Thanks. Dr. Patnaik.
Good afternoon. I'm going to talk about the challenges that a government faces in an emerging economy to finance resilient infrastructure. Not just India, these issues are faced by most emerging economies, particularly because our infrastructure gaps are huge, and all the time we are facing trade-offs. You know, it's very easy to say that we should build something which is very resilient, but then there is always this question of we want 2 bridges because the river doesn't even have one. So whether to build 1 resilient bridge or to build less resilient 2 bridges. And since it's a decision that politicians have to make, that's an even more difficult decision because politicians have to go back to their voters every 5 years, in India every 5 years, and however often elsewhere. So there are a large number of issues, trade-offs, challenges that are faced when we think about a country that is trying to build infrastructure and trying to choose how resilient that infrastructure should be. Usually, it's really the government that bears the cost. It bears the cost both of building the infrastructure. It also bears the cost of damage to the infrastructure. So the infrastructure, even if it is contracted out to a private contractor when it is being built, but ultimately, upon completion of the construction, it is publicly owned. 3/4 of all infrastructure projects in the world are funded by governments. And then after the funding is over, then they're owned by governments. And even if we talk about the remaining 1/4, and even if the project is not publicly owned, but is privately owned, when there is a disaster, the government has to step in. The government, for example, cannot let a bridge remain unbuilt and people stuck on both sides and not able to cross just because the private owner of that bridge is unable to build it back. So it does become the responsibility of the government not only to help people, but to get the economy back on track. So this is an issue that has to be confronted by governments, and particularly, as I said, our governments which are building new infrastructure. This raises 2 questions. One, how much should it finance mitigation? So how resilient should be the project that is being built? And second is how to finance the residual risk, because no matter how much you mitigate risk and how resilient you build the project, there will always be some residual risk. And so it faces these 2 questions, and that's what we're going to look at next. First, let's start with financing mitigation. So it could be that the upfront costs are much higher. Some of the calculations that we've heard and we've also discussed this morning they're not all that much. They might be 10 to 15% higher, but when you're a poor country, when you're struggling for every rupee, then even 10 to 15% higher is a big cost. However, if you do put in more money up front, you might reduce life cycle costs. And it's something that most of us would say is obvious, and that's what a government should do. But when it comes to balancing your budget every year, it is not that obvious, because very often it is easier to spend less now. So that's one issue. and that is, you do want to put in money for mitigation, but there is always this question of how much can I afford to put in today? Typically, when we look around, particularly in the advanced world, what do we see the mitigation money being used for? It's often being used for risk assessment. So you have hazard, exposure, vulnerability assessments, you develop risk atlases, you have early warning systems, and the money for mitigation is essentially being put into these which are public goods. So no single project, no single private developer, no single private project manager would put money into these public goods. I, of course, believe that insurance companies have got together and have developed their models, but a lot of the mitigation funding, therefore, goes into public goods of this kind. The second is where support is given for local capacity building around disaster prevention, and these could be small projects which the government encourages for communities to do, so that, whether it is levees or whether it is small embankments that are made, but that's for local communities, and they are given mitigation funding sometimes. In addition, there may be bigger projects, cyclone shelters or embankments that are made for basically reducing risk. The mitigation funds, if we look around the world, whether it is Mexico or Canada or even the US, the funds are typically quite small. The amount of money, the most famous, especially if you go to the World Bank and talk to them, is that they'll tell you about the mitigation fund in Mexico, but it's about $25 billion. So it's not a big amount of money. Yet, because it creates public goods, it is useful. Now, in India, the way we've approached it so far is that a percentage of every infra project is supposed to go into a flexi fund that supports resilience of the project that is being developed. It's not very clear how the funds have been used so far, so I'm not able to present to you an update on the actual use of these flexi funds, but that is the mechanism that currently exists. There are also mitigation projects that are supported by multilaterals, such as the bank, I think, supports a national cyclone risk mitigation project, and there is a dam rehabilitation and improvement program. In addition, there are also early warning systems and some projects that support retrofitting. Now, when it comes to an infrastructure project, one question is, what is the optimal level of resilience? Are you going to build a bridge that is going to perhaps be resilient if there is a flood, which is the kind of flood you'll have once in 20 years, or the one that is once in 50 years, or the one that can happen once in 100 years? So will the height of your bridge be 10 meters, 20 meters, or 40 meters? The cost will depend on which one you choose. It is not always obvious that you have to go to the absolute extreme, because there are trade-offs. When you're spending money in economies like ours, we're always trying to build more infrastructure rather than less. So it brings us to the question of what is the optimal level of resilience that we want to aim for. The second question that we face is, how can we encourage mitigation? In many of the sessions this morning, we've heard about how difficult it is to monitor building codes implementation, for example. That while the laws may exist, while the money may be there, while there may be many codes there, but really, do people follow those codes? And while one may say that one option can be to, yes, go and take permits and have two officials sitting in the municipality department who will say, yes, this building is fine and is following those codes. But what are the incentives for the people who are building those codes. What sort of, maybe it could be risk-reflective insurance premiums, maybe not, because there isn't very good evidence that those actually create incentives for building resilient buildings, for example. The third question that it brings us to is the role of insurance and insurance premiums. Now, while for developed economies where they do use, there are well-developed insurance markets, that's not the case in countries like ours. And if we were to think about, even for housing, so if we were to, let's just say, copy some of the models that are there in the West and say we are going to make it compulsory to have housing insurance because you are in an earthquake-prone area. Even so, would the fact that the insurance premium reflects the risk and therefore is higher for those who don't build the right, correctly level of resilience, will that make them actually improve their building, or will it not? I mean, even for the West, the literature I've read, the evidence is not all that clear that these premiums make such a big difference. So the question that we face is, typically human beings don't assess risk properly. Typically, they don't put in enough for resilience, and that's something which is even, I would say, stronger without evidence, but I believe stronger for those who are very poor, for those who are barely making ends meet. How do you incentivize risk reduction? The second question, as I said, was, what about the residual risk? Even if, suppose, we were able to solve the question of mitigating risk and reducing it, there will be risk that we will be holding. Do we wish to retain that residual risk, or do we wish to transfer it? So there could be a mechanism with more or less what we have today, which is that governments hold residual risk, or they could choose to transfer it. Now, if you have a large diversified economy like India, you might choose to hold the risk. And if you have the risk of low intensity and frequent disasters, you may not even be able to transfer it because the price of insurance may actually be too high. No insurance company might be willing to sell insurance to a country that has regular floods. So for the Indians, I would say the example of Kosi floods. Maybe no insurance company would sell the Bihar government insurance for Kosi floods because it's certain that in every 2 to 3 years you may have floods and you bear the costs, and so the premium that would be charged for it would be as much as the cost of what the government has to bear. So if you have low intensity frequent disasters, you may actually choose to retain the risk because you may not even be able to transfer it at prices that are worthwhile transferring that risk. What you may want to do is the government could borrow more, it could tax more, it could take international aid, it could reallocate resources from other uses to this use. It could build up a kitty of reserves to be used in the case of a disaster, and so on. So those are the ways it could handle retaining the risk rather than transferring it. Now, this is really the job of the Treasury's debt manager to decide whether I should borrow, at what rates, how much, or should I try to find some other mechanism? Should I be buying insurance, even that, a parametric insurance as we just heard about, that it could decide that it is worthwhile for it to, especially for if you're a small country and you have very low frequency, high intensity disasters, then you might choose to transfer the risk, and that would be a decision that would be made by the debt manager of the government. Now, in the case of a federal country like ours, in a way, each state is transferring risk to the central government. And then it could be the central government's decision on whether to hold that risk, or if it wishes to transfer it, to find the mechanisms through which it would transfer this risk. Alternately, states could come together and choose a mechanism through which they would pool their risks and then could take this decision. I don't have the time, so I'm going to skip the details about India, but just for another minute before I finish, I want to talk about what about privately owned infrastructure, because if you look at the kind of needs for infrastructure that we have, increasingly more and more infrastructure is getting financed by the private sector. The state has very limited capacity to monitor. So what should be the mechanisms through which we ensure that the privately built infrastructure is also resilient? What should it be? Who should assess those risks? So for example, banks that lend to, or investors who lend to these infrastructure companies today don't have the capabilities of assessing risk. Perhaps that's what they need to do. Or they need to have mechanisms with, did you call it blended finance? Blended finance, where they work with insurance companies and find mechanisms to monitor the risk. If the project remains on the balance sheet of a private infrastructure company, it might be in its, it might have the incentives to actually do better maintenance, to put in more money upfront, and to make it more resilient because it remains on its balance sheet. But those are some of the questions that need to be addressed when we think about this large growing share of private infrastructure and how we will make sure that that also becomes resilient while we solve the difficult questions of how public infrastructure has to be resilient. Running out of time, all I would say is that there are risk models developed by insurance companies which are something that would be very useful for states to have if there were ways for governments to have if there were mechanisms developed for sharing this sort of information. And one hopes that the coalition that we are proposing would be able to bring this knowledge together and bring the information that already exists to governments who are able to then use it better. Thank you. I'll stop there.